started. So what is a reverse mortgage? So reverse mortgage is actually called a HECM. So it is a home equity conversion mortgage, also known as a reverse mortgage. So as you guys mostly know, is like conventional loan, FHA loan, VA loan, those are actually called forwards in the mortgage world. So we always kind of like to distinguish the two. So this is what's interesting about this market. And if anyone is in the real estate space and they're looking forward into the future, hey, where's the business headed? What's going on? It's this market right here. So the number of older Americans age 65 plus is projected to increase from 43 million in 2012 to 84 million in 2050, and then 92 million in 2060. I mean, that is a large amount of population that is going to be in that retirement age, no income, just their, pension, Social Security, and then whatever money they've saved up for the retirement for assets. So this is kind of just broken down into what we notice in the retirement world. You got your checking, you got a little bit of money in your savings, you got some money market, you got your 401k. But then what's interesting is here in America, the biggest amount of assets is in home equity. I mean, that is crazy to think that most of people's net worth is in the equity of the home that they live in. And if they're of 62 years of age and they're living at home, they're not really doing anything with that home equity. Because to get a cash out refinance, you have to qualify for the mortgage payment with the income that you're making. And some people can't qualify for that. So we're going to go in today on how you can qualify for that. So here's the eligibility requirements for the reverse mortgage. You have to be 62 years or older. Now, if you and your spouse if one of you is 65 and one is 59, we can make that work. So as long as one person is of 62 years age or older, then we can make it work. But really, you would like it for both of you to be 62 years or older. Live in the subject property as their primary residence. Demonstrate financial capacity and credit responsibility. So how this works is the clients will actually go through a counseling class for this program. It's either through Zoom or it's in person, but you have to go through those counseling classes in order to do this loan program. That's something they changed years ago, back when a lot of people had misconceptions of this program, was because they were getting the older folks into this program and not really explaining it to them. So now we have this added process of they have to go through the counseling program. So I really like that part because they explain it to them, they walk them through it and make sure it's a good financial position for them to move forward with the reverse mortgage. And then, yeah, like I said there at the end, have to go through the counseling class. So here's some common misconceptions of the reverse mortgage. Reverse mortgages are for desperate seniors or for the house rich but cash poor. The home must be debt-free before you can qualify. When the reverse mortgage comes due, the bank sells your home. The bank owns your home when you take out a reverse mortgage. All of these are wrong, 100% wrong. We're going to go into some different scenarios today, and hopefully you guys will come out with some better knowledge about this program. And what I'm hoping is maybe as we're going through this program, you might think of 1, 2, or 3 different people in your life that this could actually benefit their life too. So you can actually use a reverse mortgage to purchase a home. A lot of people don't really think about this, but this can make the purchase of a home easier and more affordable for your clients who are 62 or older. We're going to go in some different scenarios, but basically how it works is you can sell your home and you make, let's say you're going to sell your home for $400,000 and you want to move into that new retirement community and that new house is going to be 700,000. So you've got about $300,000 gap in order to purchase that home. Instead of just getting a normal mortgage, conventional FHA, and having to qualify for that mortgage, you can actually use a reverse mortgage on that new home, get that $300,000 mortgage, put down the $400,000 on the $700,000, and then you will never have a mortgage payment on that new property. So now you're moving from your old home that's probably not maintenance provided, and it's probably outdated. Maybe you don't want to live there. Maybe it's, it takes too much, for them to maintain. And you can move to that maintenance provided villa that you really want to be in, maybe all one level, and not have to pay $700,000 of cash. You can get a loan for that little bit of difference, 200, 300,000, and then you can purchase that home with a reverse mortgage. Now, when you get a reverse mortgage, same with a purchase or whenever you're doing on your primary residence, there's no mortgage payment. All you have to do is make sure you maintain the taxes and insurance of that home. So here's our first case study. I'm just going to go through it. If we have any questions, just raise your hand or just speak up. But Bill is 62 and single, has a $600,000 home with a $265,000 mortgage. He'll need to make mortgage payments of $2,200 per month for 13 years, well into his intended retirement. He is still working full time. The challenge is Bill plans to retire at 67, but is concerned about making his mortgage payment from retirement income he has saved, but has not been able to max out his 401k contribution. Bill would also like to have more liquid funds available for contingencies. He would like to find a way to make retirement work without extending his planned retirement date. Whoops. So here's the solution. By getting a reverse mortgage for Bill, it completely wipes out his mortgage payment with the reverse mortgage. So he shifts the $2,200 a month, which is $26,400 a year, towards savings instead of paying on his mortgage, increasing his deductible 401k contribution and maxing out his income / matching funds. After paying off the mortgage, Bill now has $93,000 available credit line from his reverse mortgage. Bill saves $342,200 in mortgage payments over the 13 years remaining on his mortgage that can be used for other retirement goals. That to me is a win. That's a huge, huge win for clients that we're seeing today in this market. They want to retire, but they don't think it's possible because they have this large mortgage payment that they're afraid that they're not going to have enough income for. Case study 2, the Reyes couple, both age 69, have a $525,000 home with no mortgage. They have a pension and $500,000 in portfolio assets. How can reverse mortgage help them? Well, you can actually get a reverse mortgage credit line. So like it's a home equity line of credit. So with the credit line, and this is what's interesting with the credit line, is you can actually, the credit line will increase over time as you don't pull money from it. So for example, if they pull out the credit line at $252,525 in year 1 at age 68, by age 88, this could grow up to $645,000. The funds can be drawn for home care or other purposes. No additional income taxes on reverse funds used. That's a huge win. So what can they do with these funds? They can pay for long-term care if they needed, protect against market declines, or help grandchildren pay for college without student loans. So some other reasons to consider a reverse mortgage: you can eliminate a monthly mortgage payment. You can use the money to supplement income, pay for medical expenses or in-home care, finance the purchase of a new home, pay off debt, and enjoy passions with financial ease. One other consideration that I don't think we have in this presentation is you can actually use a reverse mortgage. So for example, let's say you own a home in Kansas City, and let's say your home is worth 600,000. And let's say you owe 200,000 left on that home, and you're paying $2,000 a month on that mortgage. You can get a reverse mortgage on that property, take out, say, another 150 to 200,000. So that takes away the 2,000 a month mortgage payment. You're able to pull some cash out, and then you can add that cash, maybe the 150 or 200, to another 200 that you have in saved up, and you can go purchase another home in, say, Lake of the Ozarks or in Florida, maybe a vacation home, cash. And now you have two homes without a mortgage payment on each. And then you just have to make sure you maintain the taxes and insurance for each. And now you got a home in Kansas City, and you've got a home, maybe, you know, a secondary home that you can use for your family for, you know, your retirement or, you know, vacation. I like to look at it from that standpoint, because then, you know, you can actually buy a second home in other cases you didn't think were possible. Before we move forward, does anyone have any questions over any of the stuff that we had just went over? Perfect. So Kelsey, I kind of just went through the presentation pretty quick. Just went through some different scenarios. For those of you don't know, this is Kelsey Walsh. Like I said, she is our reverse mortgage specialist on the team.
Hello.
Kelsey, how many reverse mortgages do you think you have helped clients out with?
Well, we've run lots of proposals. Sometimes, you know, they're either not quite in the right spot yet, or you know, it's a little bit longer site decision process. So lots of those. We've probably closed about 10, I'd say, which doesn't sound like a lot when you're used to forwards, like we do that in a week, right? But I mean, that's more than like what a lot of companies are doing as far as reverses. So
For sure. So I think my question to you is, a lot of people have a lot of these misconceptions, and we kind of went over them in the presentation, but there's a lot of misconceptions about the reverse mortgage market. One thing I want you to talk about or tell them about is the loan to value requirement on a reverse mortgage, whether it's your current home that you're pulling cash out or trying to just get rid of the mortgage payment, or a new home that you're purchasing. I think a lot of people in the world of real estate are concerned about being upside down on a home and not being able to, I guess, sell the home if they need to.
right.
So can you kind of go into detail as far as the age and what the loan to value looks like, meaning how much your mortgage can be on how much the home is worth?
Yeah. I wish there was like a set chart so I could say, if you're this age, here's the loan to value. If you're this age, here's the loan to value. It does vary, but it starts, the FHA insured HECMs do start at age 62. There are some products out there, they're considered jumbos, that go down to age 55, but we're not really talking about those today. So they start at 62, and the loan to value is based on the age, the product you pick, whether you're doing a fixed rate or an adjustable rate, and there's reasons you would pick one over the other, the interest rate, and then the value of the home. So a lot of times people have this idea that it's around 50% just off the top. Well, if you're 62, you're actually young, really, really young in the reverse world. So I tell them a lot of times, good news, bad news. Good news is you're super young. Bad news is you're not quite enough equity yet to where you could take advantage of this product. If you're a lot older or on the later spectrum of underwriting, then you don't need as much equity. So it really depends on where they fit. Obviously, if rates are a lot lower, like they were the last few years, and you have your mortgage growing at 2% versus 8% or 7%, I mean, reverse rates are very similar to forward rates, so they're going to follow the same trend. But the higher rate, you're going to need more equity, because the idea is that this mortgage lasts to the end of your lifetime. And then, Brady, did you talk about how it's a non-recourse loan, and like if they were upside down in a off,
Yeah,
you know.
I wanted
Okay.
you to go into detail with that too, if you can. I actually had a situation this week. A real estate agent called me and said, "Hey, I've got someone that has reverse mortgage. They're trying to sell their home, and I believe that they might be upside down. Can you go into detail on that?" And I kind of talked on it, but yeah, I want you to touch on that if you can.
Sure. So the nice thing about the FHA insured ones, that FHA insurance premium, it and all the products actually are non-recourse loans, which means if you are upside down, no one's on the hook for the difference. You can sell it, and then whatever remaining balance is owed, it's considered paid in full. So it's not even considered a short sale as long as you sell it. I mean, don't let it just sit there and foreclose, obviously. But then the cool thing is if you have heirs who are going to inherit your house. So a lot of times people are worried about, oh, their equity, or they want to leave something to their kids. If say, well, first of all, if you live to the point of your reverse outgrowing the value of your home, then I think you did a really good job with living and using the reverse to your benefit, right? You went that long without a payment, or you took all the equity and you had a great end of life and maybe it paid for medical, whatever. So I think that's actually a good thing. But the nice thing about these reverses is your heirs can actually purchase the house for 95% of whatever the appraised value is, regardless of the balance. And the rest is just forgiven. So, there's always at least that safety net that they wouldn't, they could keep the house if they wanted to.
So you're saying so if my parents get a reverse mortgage and they both pass away, and then it goes to me, I have my decision. They give me what, 12 months to figure out what I want to do with the home? Is that right?
At the most, as soon as your parents pass away, say it's both at the same time, just for example, they'll send you a notice, and you need to communicate with them. You can't just ignore them for 12 months. I think that's a big thing that, if people don't know what they do, they don't answer, just communicate with the servicer. And this is all in the counseling and stuff too, but then
Yeah.
you just let them know, like, hey, we either don't want it, we want to walk away, or we want to sell it. Or if there's a lot of equity, I mean, depending on when they got the reverse, depending on if maybe they didn't even tap their line of credit at all and there's a lot of equity, they can still have all that equity just like a forward mortgage.
Gotcha. So, but let's just say the reverse mortgage, like you said, they lived in the house for a long time. The reverse caught up to the equity of the home or to the value of the home, and it's a little upside down. And then I take over the home as the heir. What happens there as far as I take it over. I don't want to buy it. I just want to sell it. I just want to, get over it. Do I just let the bank do that? Do I hire a realtor and have them sell it? Like what's your
Yeah, no,
recommendation
I
there?
wouldn't let the bank do that, because I mean, if there's equity, or even if, well, you can just walk away and there's no recourse. Like even in the forward world, it's not that nice. So you could just walk away. If there was any money to be made, yeah, you can just list it and let the reverse servicer know that you're selling it, and then they'll give you time, and then they'll check in and be like, has it sold? You really do have up to about a year, and then they'll start to say, hey, because there's still a mortgage on it. Like, then they'll say
Right.
this is due, or let it
Right.
go. But yeah, you just work with them on that, and if that makes sense, or if you want to walk away, if that makes sense.
Okay. Gotcha. And then I believe I touched on this, but you as the client or the person that's holding the reverse mortgage, you are responsible for maintaining the taxes and insurance on that home for as long as you have the reverse mortgage, correct?
Yes.
Okay.
Even if you have a paid for house, if you don't pay your taxes in a bit, you could lose your house.
Right, right.
um,
I'm just trying
yeah,
to
right,
establish that there's no escrow account with these reverses. So
right,
people have to make sure that they save up enough money to pay their lump sum on their taxes and insurance each year.
correct. Now,
Perfect.
if well, if there's really challenged credit, sometimes they can ask this, or someone can opt in for this, but it's called a LISA. It's loan expectancy set aside. So if they wanted to, you could take a chunk of your equity and set it aside for taxes and insurance, and then the servicer can pay it for you.
Okay.
Otherwise, if that is not set up, and that they use a huge chunk of equity because it's going to pay taxes and insurance for the rest of your life. So if that's not set up, then yes, they need, and most of them don't set it up, but then because you have more flexibility with changing, insurance, things like that. So otherwise, yes, taxes and insurance, you have to keep up on that.
Okay. And let me ask you this, because I feel like this is a question we get a lot is, let's say I've got either a really small amount of mortgage left on my current home, or I don't have a mortgage at all. And I want to do a reverse mortgage so I can pull some cash out in order to maybe go buy that vacation home, or to just have money that I, want to use to either pay off debt or help my kids out with colleges or whatever. With that being said, like, do I as the client get to choose to take out a lump sum, or do they pay me, in installments each month? How does that work?
Yeah, they can choose. I mean, it depends on, so one thing I love about these is they're a solution. So if somebody needs a monthly supplemental income, they can set it up that way. And then we run the numbers based on value of the home, their age, how much they could get, and they could get 1,000 or 500 or 700. They could pick up to a max of what would last towards the end, life expectancy, what income they could get each month. Or they could just set up a line of credit. Well, I think the very first one I did, her husband had just passed. She had a paid for house, but very limited, small fixed income, really no savings. Very nice part of town. So even the taxes, she's like, I don't even know how I'm going to keep up with my taxes. But so we just opened a line of credit, and she was going to use that for a roof. She called me a couple months later and said, I just paid my taxes. So it was just kind of a comfort, and her daughters were thrilled because otherwise they were, going to have to help her out. And she obviously couldn't take on a house payment. So that's one option. You can take a lump sum. Like you said, to buy a second home or a lake house or whatever, they get to pick. And we can run all those scenarios for people too. If they're just curious, we can run those scenarios. And then we run, okay, if they wanted an income, here's what they could get. Okay, if they wanted a lump sum, here's the max they could get. If they just wanted a line of credit, here's what that would look like. Here's what it could grow to. Yeah.
Awesome. And within this program, I feel like a lot of people, like I said, there's a lot of misconceptions in this world. So my one question is, what if my wife is 59 and I'm 63? Can we still do a reverse?
You can. They're going to, and you have to be married for the other. So if you don't have to be married, if you're married, then we can't ignore one of the spouses, because the idea is if the other one has a reverse, they can't just kick out the other person. So they would underwrite it based on the younger value. So if 62 is where it starts, but your spouse is, 55 or whatever, they're going to underwrite it based on the lower age life expectancy. Some of the proprietary products that are not the FHA ones, you can go through a bunch of hoops to not have that spouse on there, but you have to get a lawyer to write off on it. Like, they really do protect the seniors in all of these situations to make sure that everyone involved is aware, and that what would happen in case of if this were to happen. So yeah.
Okay. And I feel like the other question we get a lot too is, if my spouse and I get a reverse and we're about the same age, and let's say, we're in our 70s and my spouse passes away, then technically, if we're both on the loan, then do I have to do something with the mortgage, or do I get to continue to live in my home the same way?
Yep. So if you're married, even if one of you gets the reverse, you typically would put both on there unless for some reason they don't want to, or they don't qualify, or I have had one who's like, I just don't want to be on anything. So that mortgage doesn't come due until both of them leave the home permanently, and that can be to go to heaven or long-term, live somewhere else, long-term facility. It, on that note, I've gotten this question too. What if they go into a nursing home and then they plan to return? If they're gone for more than a year, that's when they're gonna say, hey, we need to call the note due. But if they go away and then come back, that's fine.
Gotcha. Okay. I think that's
Did
kind of all the questions that I really get. Is there other questions that you guys are wanting to ask? Looks like we got something in the chat here. Kristen said, I understand how this benefits the borrower, but how does this benefit the lender?
so at the end of the
Um,
day, oh, go ahead.
no, go ahead. You got it.
So reverses are backwards in that sense too. In the forward world, we get paid monthly mortgage, principal and interest, and the servicer, whoever's collecting payments, makes their interest, right? And then they sell the loan. If they sell the loan, they make money that way. In the reverse world, also backwards, like everything else, they get their money at the end when the loan is sold. So that balance is accruing interest over time. Instead of them having to make a payment, it's accruing interest over time. So the lender gets their money at that time when the loan's paid off. So they're really, it's a patience thing.
Yeah, great question. So yeah,
Yeah.
and I don't think we touched on this very well, but the balance of that loan of the reverse mortgage will grow as the interest rate set. So as Kelsey was noticing or saying is back when rates were 2 or 3%, your balance of that reverse mortgage did not grow that fast. Now when they're in that 7% range, they do grow a little bit faster. So with that being said, Kelsey, if I get a reverse mortgage today, I want it, I need it, I want to move forward. I know the rate's 7, whatever. With that being said, can I refinance when the rates go down to maybe 5? Like, would that benefit me?
Absolutely. I mean, I would say so you're going to have to pay a FHA premium, just like on a forward mortgage. There's a premium paid up front. So I just look at the cost versus the savings. And I would say if you could go from a 7 to a 5, that would make sense. So yeah, and you can refinance them. You can, if down the road you decided you wanted a forward mortgage for some reason, you can refinance and pay it off with a forward mortgage. You can also get a reverse and still make payments on it if you want to, but you have the option. So maybe, if rates do drop, maybe that's a good time for someone to put one in place and then, but still treat it like a forward, but then they have that option should the time come to just not make payments and no one's going to come after you.
For sure. Yeah, great question, Kristen.
Yeah.
Is there any other questions you guys have out there? If you want to put in the chat, or you can.
Oh, she said, are there fixed rates or is it all adjustable? No, there are fixed. So it depends on what you're wanting out of it. So I would say, a lot of times the purchases are fixed because you're putting down a chunk of equity and that's that. You're not necessarily going to have a line of credit unless you overfund it. You're not going to be drawing income because you've maxed out the amount at that time based on age and value of the home. If you take out a lump sum, you can do a fixed. But if you're drawing monthly or if you want to open a line of credit, those are typically adjustable. And I do have one now that's a purchase, but we're doing it as adjustable because it allows her to bring less cash, or her and him to bring less cash to closing than if we did a fixed. So there are both options. We just look at what's best for the borrower and what they want. I usually present all the options and then go through it with them and let them decide what they want.
Perfect.
Yeah, good questions.
Anything else you guys have? Well, while they're thinking about questions, Kelsey, is there anything? I know, like I said, you've probably run 200 scenarios. You've closed a handful. You're helping clients. People are happy, right? Right. I think one of the misconceptions that we put on here was like people who are doing reverses are stuck in a pickle. That's not the truth.
I was going to ask if you talked about that because I know I was late and I don't know if this is realtors or advisors or what, but yeah. so it's not just for people in a pinch. Like one of the loans I did was for a guy in Florida who had more than enough cash to just pay cash for this house, but he's like, why would I want to? He's like, I want to keep it in my investments. He's like, I'll put down whatever I have to. He goes, but I also don't want a house payment because why would I want to? So he put down what he had to put down and we did the rest with a reverse and he got to keep more money for himself. And he was just kind of a savvy guy like that. You also have your examples of depending on where interest rates are and where the market is. Maybe if they are retirement and pulling stuff out of IRAs or retirement accounts, maybe depending on what the market's doing, it would make more sense to utilize your equity to subsidize your income instead of drain your investments. It just every situation's different, but it isn't what you're saying. It like you're right. Most people think, oh, it's that last resort. They're just desperate, but it's not. That is absolutely not always the case. I think even right, your father-in-law is like, I'll take advantage of one when I'm old enough. Like, I think I'm so educated on it, and I'm have such a passion for them. I'm like, okay, I got 20 years, and then I'm doing one. So, yeah.
I think so. The first two things that come to mind for me is, for my future is I think about like a lot of people want to keep their house owned free and clear, and they're like, well, I'm just going to give it to my kids, and they're going to do whatever they want with it, right? Well, I mean, I would imagine probably 70% of the time, I'm just pulling a number out of the air. They probably sell the home and just take the cash anyways, right? So the first thing I think about is for my kids, why wouldn't I want to take a reverse mortgage out now, take the money and say, hey, son, daughter, if they're in their 40s or 50s, hey, here's the money now. And I want to be alive whenever I see you guys do whatever you want with this money, right? The second thing I think about too is like I was talking about is I can take a reverse mortgage out on my current home here in Kansas City, and I can go buy a vacation home for my family and buy it in cash, right? Using the equity of my current home along with some savings. And when they go sell my current home, they don't make 100% of that equity because we have a reverse mortgage on it. So maybe they make a little bit of money, maybe 100 grand, but then they have a paid off free and clear house at maybe the Lake of the Ozarks or at Florida or somewhere where they can now take their kids, their family, visit there, remember my wife and I and what we were able to provide for them. And all they got to do is pay for the taxes and insurance on this home. And they could rent it out. They could Airbnb it if it's in an area that allows Airbnb. And they can make money off of that. Maybe an extra $20,000 or $30,000 a year that my kids can split between each other and also use it as a free vacation, right? Like those are some things that I think in my head without thinking about, hey, who do you know that's stuck in a pickle that really needs cash right now, right? Like we're not the we buy ugly houses. It's not the, hey, if you can't make your mortgage payment, do this. Like it's not that type of program, right? Now, some people do use it that way. Like, hey, I want to use my equity because, I'm in a place that I want to stay in my home, but I don't have enough assets. People do use it that way, but it's not 100% used that way. So I think that's a big thing that I always try and tell people out there is that's not the way it's meant to be. So
I think that's why we like doing these is to educate people because there are a lot of ways that you could get creative with it. And I think the more comfortable people get with the products, the more you'll hear about those fun stories of, oh, guess what we did? This is awesome. And just also, I mean, we're in the Midwest, right? We're the last to get the fashion trends. We're the last to get everything. Like these are popular in Arizona and California and Florida. I mean, they're called the silver loan or whatever. They're already just common and comfortable, and so we're just trying to bring that knowledge to the Midwest sooner than later, I guess.
Yeah, for sure. I mean, and like we had talked about in this slide here is we in real estate always want to look towards where the business is headed. Where are we headed? Now, we do have a lot of millennials that are getting into the industry that are trying to buy their first home, but we also have a lot of older folks that are getting into that 65 plus age range every single day. And we can see that number growing to the point where these are going to become a lot more popular in the next 5 to 10 years. You're going to see this become a trend. And I think as a real estate agent, to be informed on this and know where the trends are heading, this could be where your business could lead to. If you've been in the industry for 10, 15 years, you know, think this. Think, you know, you got forward thinking.
Well,
Kristen,
go ahead.
Kristen's got a question here. Will the withdrawals be taxed?
That is the beautiful thing. They are income tax free, completely income tax free. Great question.
Right
Sorry, I
here.
was
No
trying to exit
additional
out.
income taxes on HECM's
Heckam
funds
funds.
used.
That is your money. So when I very first started doing these, I kind of had a hard time wrapping my head around it. Gonna be honest. I'm a finance major. I'm a forward loan officer. I was like, this kind of just, it sounds too good to be true. Like, what's the catch? All of those things. And this is what clicked for me. If you think of your home as an annuity that you've paid into for 30 years, and then you have access, what's that called, a Roth, where you don't have to pay taxes? I don't know. If you have
Yeah.
access to those funds, that's your money. You put it there. And so once I started thinking of it that way, then I'm like, why not borrow from yourself? Why not borrow that money that you've paid in to your equity, or earned equity just by owning the home? Yeah, so that's when it kind of clicked for me that this really does make sense. So yeah, income tax free, which also, Kristen, like, in a financial world, if you're considering equity versus your IRA or retirement funds, sometimes you might, compare those two things too. I'm not a financial planner, so those, talk to somebody else, but just ideas.
Yeah, and I think that's the big thing too, is we partner and talk to a lot of financial planners, especially with the clients, and we partner with them. We come together and we say, hey, is this right for the client? Does this make sense for the client? Because you really got to look at the full financial picture of the client. And a lot of financial advisors will talk to us and say, you know what, after talking to you guys and after looking at their financial picture, yeah, it makes great sense, right? Sometimes they come to us and we talk to them, they go, you know what, I really don't think this makes sense for the client. So we're in it for, this has to make sense for you and your client, your friends, your family members, whoever is doing this. You know, we go the extra mile, like we talked about. They go through a counseling class. This is not a 1, 2, 3, get mortgage, push here, get mortgage, sign
Right.
here. You know, it's not like that. This is a little bit of a more strenuous process. But the reason being is because they don't want mortgage companies out there taking advantage of the older generation and getting into something that does not make financial sense for them. So that's what I really, really like about this. I know we have integrity here at Leader One Financial. Can't speak for some other companies out there, but that's what's great about this reverse process, is you have to go through that process.
And I think before we had the question, oh, and then I'll answer that one. What you were saying, Brady, too, as realtors, I think the awesome thing about these trainings and just knowing about the products is because we are going to start getting these questions more. You're going to have, it's going to just become more commonplace. I think it's great to be that agent who's like, absolutely, let's talk about it, or I have a resource, instead of, oh no, those are bad, don't look at that, or I don't know about that. Like, at least you can feel like, okay, yeah, I get why you're asking me that question. So it does add value just to know a little bit, if that makes sense.
Oh yeah, for sure. Definitely.
Where is the growth of what you can withdraw come from? Is it the expected value of the home? Oh, title person. Yep. Yeah. So if you do a line of credit, think of it like a HELOC. And that amount Well, it's different. Usually a HELOC, I think you got a set amount and you either take it out or you don't. So say you open a line of credit, and it's just sitting there, that amount is going to accrue based on the interest rate. And it's just set at closing up front. The reason that the company that is or that this is exists is yes, because they expect the value of the home to increase. Now, say you open a line of credit and you take out a chunk of cash. That cash is now also growing. So your line of credit just got reduced based on what is going to be left. Because the idea is that based on appreciation of the house and the balance versus line of credit, the idea is that you don't end up upside down. Like when they underwrite it, it also needs to make sense. They're not going to say, here's 500 grand and we don't ever expect your house to be worth more than 250. Like that's not going to work. So I really don't know. Did that answer your question? Kind of.
She might be talking more about like, so
Where's
where's the growth
what
of
you
what you can withdraw come from?
just the interest rate, like it sets up at the beginning.
Right.
And
That's what
you're
I'm
going to earn
saying.
interest. So think of it like stocks and bonds or whatever. You're earning interest on whatever that. So it's kind of like that.
Yep. So both. Yes.
Yes.
That is
It's
true.
reverse. Everything's backwards here.
It's all
If
reverse.
Brady and we should do this upside down, like so that everything makes sense.
That would be funny. Yeah, I mean, so both the line of credit grows at the interest rate and your full reverse mortgage. If you don't do the line of credit side and you just do the reverse mortgage, that will grow at the interest rate as well. So yeah, way opposite from a forward. As far as a forward, your balance goes down as you pay your payment. The reverse, the balance grows at the rate of the interest rate. That's why I was saying when the rates do go down from say 7 to 5, it makes sense to refinance into that 5% because then your balance doesn't grow as fast. If that
And
makes sense to you guys.
I think that's a great explanation. And I do want to reiterate, just in case, if someone, because sometimes people are really worried about equity and things like that or whatever, if somebody wanted to make interest payments, they could. If somebody wants to pay down the balance, they can. They don't have to make it grow. It's kind of like a credit card in that sense. You can just let it go, or you can, keep paying it down. But yeah.
So I think one of the things that we had talked about, one of our presentations, someone brought up was, so these people pay into basically it's that upfront mortgage insurance premium that all FHA loans pay. The reverse has that same insurance, right? What does that do, right? So is that for like the insurance fund for when a client actually gets upside down, then FHA who insures these loans can come in and pay that difference to make sure that you're not upside down? Is that what that's for?
Exactly. For. So it insures the lender and allows them to be a non-recourse loan. So if there ever was this case, and I would say the FHA is probably making out pretty sweet on this whole deal, but if you were if the person were ever upside down, that's how that's all forgiven, and the bank's not out the money, right? Because they have that FHA insurance. So
right. But we haven't seen that because realistically since 2008 we've seen double digit equity increases, especially here in Kansas City.
Like I said, for anyone to be upside down in a reverse, because at the front end it is underwritten heavily. I mean, we know their age, we obviously know their interest rate. They have a projected appreciation amount. They sometimes get to appraisals, so they make sure. So I think it's going to be very rare that somebody's going to be upside down. They're going to have to either let their house deteriorate. It's going to have to be a crazy, downfall of a market, which we don't anticipate. Or you live a really, really long time. So who's going to be mad about that?
For sure. Definitely.
Any other questions?
Any questions other than some great questions there, Kristen?
Yeah. And if anybody ever wants us to run a scenario, we don't have to pull credit. We just need birthday, estimated value, and we can, you know, and then if you owe anything on the home, and we can run scenarios for anybody that wants it.
And I think from a realtor, you know, or real estate agent perspective, you know, if you are in an area where you notice you know, some retirement villas being built, or you know, maintenance provided homes
Yeah.
or villas being you know, built in your area, this could be, you know, a possibility where if you want to reach out to us and do some sort of seminar for clients in that area or for potential buyers, we would love to come out and present something along this. We can co-brand it with your information, and really help your guys' business out. I think this could be a potential, you know, resource for you guys with your business as well. So if you guys
Absolutely.
ever need anything like that, reach out to us. I know we're recording this, so I had a lot of people reach out and said that they had team meetings and whatnot going on this morning. So we'll be sure to send this recording out. So anyone that's recording, you got my information. You got Kelsey's information down here at the end of the slides. Reach out to us. Ask us questions. Use us as a resource. We also do forward loans. So if you guys are, you know, looking for an FHA, VA, conventional USDA down payment assistance, we do it all. So reach out to us for that too. We can definitely help out in that sense too. But we appreciate your guys' time. We don't want to take up too much of your time today. So if you guys need anything, reach out. And other than that, have a great rest of your day and a good week. And we'll come to you guys soon with another educational piece.
Thank you.
Thanks, guys. See ya.